How is everyone doing? Welcome back to another episode of The Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk about digital lending platforms and should your bank, if you're not already using one, should your bank consider adopting a digital lending platform? I came across a great article, or I should say a blog post rather, in PCBB, and this is titled Benefits of Digital Lending Keep Growing Along with Loan Volume. So the summary reads, digital lending platforms can help banks save money, make better lending decisions, and build a better loan portfolio. We discuss the benefits of adoption in a growing loan market. So, let's see here. Where do we want to pick up here? So let's pick up with a growing lending market. So the market for small to mid-sized business loans is growing. In 2024, small businesses in the U.S. borrowed $31 billion through 70,000 loans, a 13% rise in total value and a 22% increase in the number of loans approved year over year. The Small Business Administration expects that the small business lending market will be worth $7 trillion by 2032 for a compound annual growth rate, a CAGR of 13%. Even so, large banks only approved 14.6% of small to medium-sized business loan applications, and 44% of small to medium-sized businesses don't apply for loans because owners worry their applications will be rejected. The global digital lending platform market is also expanding. It was worth $7 billion in 2022 and is expected to experience a CAGR of 26.5% between 23 and 2030. It will likely reach $20 billion by 2026, double its 2021 size. That growth rate reflects the growing lending market's demand for an efficient, convenient lending process. Now, I will say that I have reported on some of this. A lot of that data and stuff that they're getting is from the Small Business Credit Survey, which gets issued by the Federal Reserve, particularly the Federal Reserve Bank of Cleveland. Pretty much on an annual basis, they do a very large survey called the Small Business Credit Survey, and then they break it down usually into 4, 5, 6 different smaller reports. One of those smaller reports being on small business lending, and that's where a lot of this data is coming from that they're reporting on here. So again, it is interesting to note that banks are still the number one source of small business loans, but that percentage if you look back over the last 20 years or so, that percentage has been shrinking. Now, thankfully, banks are still considered, the customer is still, for the most part, very happy with the experience they're getting at community banks, but there are things that they like and things that they don't like. And the one thing that, alternative lenders, if you think of online lenders, alternative lenders, the one area that they are really exceeding in is that customer experience. The fact that they have a digital platform, somebody can go on whatever time they want to go on. They could go on at midnight. They could use, if they want to use a laptop, if they want to use their desktop, if they want to use a smartphone, whatever device you want to use, you could just go onto the website. You could apply for the loan, upload your documents or whatever you need to do, and it could be done relatively quickly. I mean, it might take you less than 30 minutes to fill out the application, put it in, and then usually within, I would say probably 24 to 48 hours at the most, you're hearing back with a lending decision. Now, all that is great. Here's where that falls apart. Okay. It's not real great on the back end. So say, the bank gives you a 5-year loan for $100,000 and we give you that loan at, today's market, let's say it's, 7%. And you have your monthly payment over the next 5 years. Okay. And you pay your monthly payment once a month. The loan's fully amortizing. So when you get to the end, it's zero and it's over 5 years and for $100,000. Well, the online lender, they may approve you and give you that money a lot faster, but that money that $100,000 is going to be owed back in 12 to 18 months. Your monthly payment is going to be huge, but you're not going to have a monthly payment. You're actually going to have a weekly payment, and they're going to hit you for that payment. They're going to automatically debit. They're going to hit your account every week for that payment. And it's a big nut to cover. And their interest rate's not going to be 7%. It's going to be like 70%. So, and that's where a lot of people fall down. It's easy to get the money, but then on the back end of it, where it's not too great paying 70% interest and having somebody hit your bank account for $2,000 every week. That has a tendency to put a big crimp on cash flow. So that's kind of the differences there right now. Now let's get into for a minute here. What are the benefits of for business customers and for banks? So digital lending platforms give potential borrowers the convenience of applying for loans at the time and place that suits them on whatever device they prefer. They can start a loan application on a laptop on a Monday morning and finish it on a smartphone over the weekend. Beyond the obvious advantage of making borrowing easier and more convenient for their customers, digital lending can also have a variety of benefits for lenders. These can include faster loan decisions that are less expensive to make, more consistent lending decisions, a competitive advantage, improved accuracy, better compliance, a dovetail with open banking. All right, I'll come back to that one later. Better overall lending. So those are the main things that basically a digital platform could do. So let's go into these for just a second. So faster loan decisions that are less expensive to make. So digital lending platforms can save banks around 8 hours in processing time and as much as $4,000 per loan, primarily in reducing operating costs. Bank staff save time when they no longer have to manually input numbers, freeing them to do more interesting and potentially profitable work. Yes, this is true. This could be done. I don't know about 4,000 per loan, but I have seen many instances where, say, your typical underwriting cost was $2,500 and it was able to bring it down to it cut that in half to like $1,250. I've absolutely seen that. So that's definitely to consider. More consistent lending decisions. So manual loan processes open banks to the possibility that human preferences will affect lending decisions. In one sense, banks are in business to make personal, human decisions. Relationships are at the core of their business. However, it's still important to understand how a proposed loan compares to a financial institution's stated risk limits, preferred loan conditions, and overall credit criteria. Digital loan platforms provide all of that. When bankers bend the rules, they do so deliberately rather than accidentally. So, yeah, I mean, we could get into a whole deep philosophical conversation on this one about, your process, whether you want it to be, fully automated and credit scored versus whether you still want a human making the ultimate decision there at the end. And then if the human's making the decision, what happens with overrides and, what does the history of overrides tell us and all that. So yeah, we could have, like I said, we're not going to get off into the weeds on that one. We'll go through the rest of the list here. So a competitive advantage. So a bank that offers a more convenient and faster lending experience is one that is set to outcompete peer institutions with traditional paper-based lending systems. Can't really argue with that one. Improved accuracy. Because information travels electronically on digital lending platforms, a digital lending environment offers fewer opportunities for manual transcription errors. These are frequent in more traditional lending formats. A 2023 Walters Clower study found that 77% of automotive dealers and lenders that rely on manual loan processes have errors in at least 1/3 of their completed loans. Okay. I think we might be able to argue that one a little bit back and forth. Better compliance. The Section 1071 small business lending rule from the Consumer Financial Protection Bureau is scheduled to take effect on July 18th. Yeah, I'm betting that ain't going to happen. It will require that financial institutions with large loan volumes collect and report lending information as a way of ensuring that their lending practices are following fair lending laws. Yes, it's true, but I don't think that's going to come to pass. A dovetail with open banking. Digital lending platforms make it much easier to consolidate borrower data, including previous loans, outstanding debt, and credit scores. Look, I hate open banking. I have made no bones about that. I hate open banking. I hate the whole concept of open banking. I don't want open banking. No bank in America should want open banking. It is the stupidest thing. For some reason, I love the guys at PCBB. They do great work. I love their blogs. I love all the information they put out there. They really do an awesome job. But for some reason, they have this obsession on open banking, and I don't get it. I don't get it. But that's their thing. Whatever. And that's their thing, and I have my thing. So, okay. Better overall lending. A digital lending system simplifies everything from record keeping to tracking client behavior and spotting market trends. So the theory goes. It can help CFIs anticipate lending demand, develop new underwriting products, and even facilitate loan participation from multiple banks. So yes, while all that stuff is true, I would just remind people 70% of all implementation projects fail. Let me say that again. 70% of all implementation projects fail. Okay. So it's not easy. I'm just saying that, the technology is great when it works, but it doesn't always work. That's the bottom line. And this stuff is not easy. It's very expensive. It's not easy to pull off. And you really got to make sure that you're picking the right fintech companies, the right vendors to work with. And like I said, you've got to have a lot of confidence in these people. So do I think at the bottom line, at the end of the day, if your bank doesn't have a digital lending platform, should you be investigating that? Yes, absolutely. I think there are I think the pros outweigh the cons. And I think you should be going down the road. You should be looking at this, especially if you're looking, if small to mid-sized business lending is a big part of your strategy and a big part of your customer base. Yes, you really should be looking at this and seeing what's going on, because this stuff is only going to get, I think, better as we go on into the future. And you don't want to be playing major catch up, 5 or 10 years down the road here. So, okay, that being said, I will wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I love getting back to everybody. And as always, make sure to check out some of the other content on the channel. I will be back tomorrow night, Saturday night, BND Strategy Room live stream. It is the main show of the channel. It's every Saturday night live on YouTube at 8 p.m. I hope, if you haven't given it a chance, I hope you come on. I talk about basically everything banking, all the major news of the week. We talk about economic indicators. We talk about what's going on in the banking world for probably about 2 hours or so. So again, if you haven't checked it out, I hope you give it a shot and see if you like it. And with that being said, I hope everyone has a great day out there. I will see everyone again real soon. Thank you for listening. Take care.